All right, welcome to the show. Sorry about the delay, I had to get some coffee. So, what's up, Brent? That picture is actually part of a custom designed guitar. I believe it's somewhere in Maryland, which is where the Paul Reed Smith plant is, but that was the material that was used to design the fretboard of a guitar. All right, so here we are, and another day of a small rally here as we take a look at the markets. All of this seemingly something to do with vaccines on the way. There was a news story yesterday talking about how the first vaccines had appeared, or the first vaccines were given to people in England. And we've seen also just the fact that we're, right now we're kind of in a holding pattern once again in the U.S. politically as we await the Georgia elections. There seems to be significant movement behind the scenes in stimulus talks. I'll believe it when I see it. I was firmly convinced back in July and August that we were going to get another package done, and that still hasn't happened, but we've seen news stories about pressure coming from governors and whatnot, and it seems like that if the if the leadership in the Senate is able to get something through, i.e. Mitch McConnell, that the president will go along with it. So hopefully we can get some sort of package through. It's turning out right now, it sounds like what is most likely to happen for U.S. individuals is some sort of extension of unemployment for like 4 months maybe, which is great, and also possibly like $300 extra a week for those who are on unemployment, and that might be retroactive. The most recent thing I heard was retroactive to December 1st, whenever this stuff goes through. The U.S. House of Representatives and the Congress has to approve a new spending bill by the 11th to keep the government running. That's 2 days from today. The talk is that they will extend that for another week and then stay in session next week until they get a stimulus package through. All of this is positive for the market. If you looked at the title of this video, it said the market is slowing down. Now, as I understand it, the VIX is pretty much calculated close to close, and thus when we had a few months ago, we had overnight action. We'd have a lot of gaps overnight in the market, and we'd also have a big range. You could routinely see, well, if you go back to February and March, you could routinely see 100-point swings in the E-minis during the day, sometimes 200-point swings. And if we look at what that's become now, the market has just kind of slowed down. And the speed of the velocity of the market changes over time. I'm trying to pull up a minute-by-minute chart here of the E-minis. But if we look right now, and just looking at the overnight action, we see this range is basically a 15-point range, or a 10-point range, right, between 37.05 and 37.14 in the last 6 hours. And I believe if we back this up, we're going to see that that kind of was the whole, let's see, so that was the whole overnight at least, and that's kind of been the story. Is stuff's just been slowing down. And I want to caution people, I don't want to appear as being always like a perma bear on the VIX, because I'm not that way, but I do want to caution people about kind of taking a stand here if we start to move lower in the VIX, because a lot of times with the stock market, once we start trending in a direction, we go farther than you would suspect, right? So there will be some people who want to kind of take a stand at 20 in the VIX, for example, or there was somebody posting on the Facebook group saying VIX gets to 18, I'm going to buy it with both hands. The thing with trending is it can trend a lot farther than you think, and we certainly saw that in 2017 when we got VIX at those extreme levels of below 10, 10 in the VIX. But my point, I guess, to you is just that if we continue to trend lower, we could stay in that movement for longer than you think. If we look at the VIX right now, if this was like quote unquote a normal stock, you might say, well, this looks like a great buying opportunity. If I pull up a year chart on the VIX, you can see we have just gone straight down, right? And we're at the lowest we've been at in 6 months. And so you might think, well, if this were a stock, you'd say, well, this is definitely a buying opportunity because stocks generally trend higher, and you seldom get an opportunity in the stock to be able to pick it up at a low, at a 6-month low. But this is not a stock, and we kind of have to get that in our mind. It can be hard to get it in our minds because you flip through all these different stock charts in a row, and then maybe the VIX is just one of those charts you flip through in a row. And I see this all the time on StockTwits. You'll see somebody will go through and analyze, it's kind of like a speed round. Someone will analyze all these different stock charts, and they'll slip in their VXX or UVXY, and they'll apply the exact same rules to analyze VXX and UVXY as they will all these stocks. And not taking into account that A, these are based on averages of futures, or B, that these exhibit decay, and C, that this relates to both of them, but these products slowly move down, whereas the general market, for the most part, stocks generally move up. So applying the same technical analysis to these products as you would to stocks just doesn't make any sense. Now, there's a little bit more of a case for applying technical analysis to the VIX than for a VIX ETP, because the VIX isn't decaying over time. VIX sort of oscillates back and forth and generally regresses to a mean. So it's oscillating back and forth, and there's some sort of middle range in in anything that's oscillating back and forth. You can kind of identify some sort of middle range, and if you're way away from that midpoint, either to the downside or the upside, then it makes sense to try to put on some sort of mean reverting play. Now that makes sense both as a buyer and a seller in the VIX. However, not as much in UVXY or VXX because these products decay so much. However, if you time it right, of course you could buy VXX or UVXY and take it for a ride to the upside. I'm not saying that that's not doable, and there are some traders who are very good at that and who actually make a living doing that. So sometimes people kind of overemphasize the points of what contango and what beta drift decay do to products. They kind of overemphasize that to the point where, like, anybody who even has an inkling of getting long these products, they're going to pile on that person and say, you're an idiot, why would you buy this, blah, 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 et cetera, et cetera. And I think that's going too far the other way, because things like contango, right now we've got contango. If we pull up VIX Central, we've got contango of, last I checked, it was around 10%. And yeah, that's significant, and that means that this stuff is decaying by, if you've got a UVXY, or let's say VXX that is $17, well, it's not hard to do the math on what 10% of that is. It would be $1.70, and yeah, over a month's time, it's decaying by $1.70. But if you're playing this, if you're day trading VXX, that number is not significant at all, right? So, so for somebody who was maybe anticipating a news story or just looking for a pop, it's not incredibly hard to get a little pop in one of these products, and they happen all the time. So, and the effects of contango are going to be irrelevant to a little pop in the VIX because the effects of contango happen over a long period of time. Even if you have 10% contango, let's say that's $1.70 a month in VXX. If you divide $1.70 by 30 days, it's almost a negligible number compared with any sort of pop in volatility. You have the Dow down 500 points one day, or the E-minis, let's say the E-minis down 50. that pop in the VIX is going to translate to a pop in UVXY and VXX, and that's not going to be offset by contango, not on a day. So I encourage people to, don't jump all over people who want to be long this stuff, A, and B, those firms and people who are buying UVXY and VXX, they're making the market. We can't sell stuff unless there's people buying stuff, right? And we used to make the joke back in 2017, I used to make the joke all the time of like how there would be new group of people playing VIX to the long side or playing these ETPs to the long side, and they'd eventually all kind of disappear because it wouldn't work out for them. And so I would always make this meme of like the short bus of VIX longs coming in, a new crop of VIX longs coming in to help pay for our children's education for those of us who short it. So there's two sides to every story, and that's what makes a market. And people buy VIX ETPs for a variety of different reasons, and they're not all illegitimate, and everybody who's long volatility is not some sort of fool. We try to educate people about the effects of decay, and certainly just looking very briefly at a chart of UVXY over time or VXX is going to show you that these products decay long term. However, that doesn't mean that you can't take a ride on these things short term to the upside. And the Facebook group that I'm involved with and other groups, we welcome people that want to trade stuff to the long side, and I don't consider it any more of a less legitimate trade than trading this stuff to the short side. It's just that long term, this stuff goes down, and there's no way to get the VVIX. We talk about the VVIX a lot. We've seen the VVIX above 100 for quite some time now. If I pull up the chart, it can be easy to just confuse the VVIX with just some sort of other VIX ETP or whatnot, but VVIX is actually quite different. It's a historical chart of the implied volatility of options on VIX futures. So if I pull up VIX in my Thinkorswim and I go to the options, it's going to show these options here, which are based on the actual VIX. They're hedged with, people hedge these with VIX futures, so if you're trading February options, you're going to hedge them with a February VIX future. And I would be very careful about trading calendar spreads if you're going to trade these options, because it's very unpredictable when you've got all these different futures. If you're hedging each month with a different future, then trading calendars on these are going to be unpredictable how they're going to end up. But if we pull up the price level of options on the VIX, that is going to give us a number, which is where the VVIX comes from. And if we look out 30 days here in VIX, that should give you a number that is similar to the VVIX. And indeed, we're around 100 here. VVIX is somewhere around 100. Generally, there's a mixed viewpoint on how helpful the VVIX is to trading. Many people who are considered much more experts than I in this space say the VVIX is at least somewhat irrelevant. For me, it tells the trend in prices in the VIX. It used to be that VVIX it used to be that most of the paper in these options in this particular spot on the VIX, most of the orders were in calls that were out of the money. So that would mean people were coming into this to buy calls to protect themselves from a move to the downside. Now, this would be a more efficient way to protect your portfolio than buying UVXY or VXX, because these options are on the actual VIX, which we just talked about oscillates and thus doesn't decay like UVXY and VXX. However, anytime you're buying an option, it has a certain time till expiration, and thus is going to decay as well. However, buying out of the money calls in VIX has been seen as a more efficient way of hedging a portfolio than, say, buying out of the money UVXY or VXX calls. Now, UVXY is leveraged, so there is a little bit of a play on the leverage there for buying calls versus the VIX. So you could have a debate, sort of, I guess, on the comparison between buying UVXY call spreads and buying calls on the VIX. But back to my point with the VVIX, since the VVIX is a measure of price level in the options on the VIX, it used to be that most of that the price level was determined by buying and selling of out-of-the-money calls. However, when we had the pandemic and the crisis with COVID, a lot of that out-of-the-money call buying paper dried up. And in fact, we've seen a switch to a lot of the paper being out-of-the-money put options. So this kind of makes the VVIX a little bit more confusing, because you could see the VVIX go up because there's put buyers in the VIX. Thus, if it's going up because there's put buyers, that it's not signaling more danger when we see a rise in the VVIX. It's actually signaling that people are thinking that stuff's going to calm down. So I always emphasize when you see a move in the VVIX, try to dig into where is that coming from. And one of the ways I do that is I pull up VIX and I go to time and sales during the day. It's obviously not going to show anything right now, but if we go to time and sales during the day, it will show us what the significant trades are that are affecting price level. And if you see that most of the trades are people buying out of the money calls and the VVIX is up, then you could say, oh, well, this is kind of showing us that professionals are hedging their positions. However, if you see it being that there's a bunch of put buyers, then you could see it as, well, professionals think that the volatility is coming in. A lot of the trade we've seen in VIX options has been these massive spreads, and we saw a lot of this, what I would kind of call a reverse risk reversal spreads, where people were selling out of the money puts to finance buying out of the money calls. So essentially, you are putting a trade on that pays for itself, that protects you against a catastrophic down move in the market. Once again, that trade would be in the VIX. It would be selling an out of the money put, taking that money and buying an out of the money call for it. I could give you an example of one of those trades if we go and we looked at Jan options here, for example. And there's not a lot of meat on the bone at the moment here, but and also these prices the markets are closed, so it's hard to give an example here. But essentially, it would be selling an out of the money put to buy an out of the money call. And a lot of the paper can be these huge trades, and some weird, especially when it's like a ratio, like you're selling 3 puts to buy 1 call, something like that. Those trades are going to reflect with a kind of a weird. It's going to affect the VVIX in unpredictable and weird ways, and thus kind of adds to the case that the VVIX can be kind of irrelevant. A lot of, if you watch Theo Trade on YouTube, they talk a lot about how a level of 110 or higher on the VVIX is like the danger zone. I think that the recent price action in the VVIX has kind of refuted that whole notion. There's nothing special about this level of 110, and you can see this whole just COVID era. You can see we've been above 110 for months and months and months, and it hasn't had any special meaning. People like the number of 100, of course, because it sounds significant. 100. Now, the only reason that we base things on, the only reason why we count to 10 and then the numbers start over again after 10 is because we have 5 fingers on each hand. Now, the fact that we have 5 fingers on each hand should not make this level significant for finance? When you think about it that way, it sounds kind of silly that somebody would say, oh wow, it's below 100, that's very significant. Well, if humans were born with 6 fingers on each hand, then the 120 level would be more significant. So throw that notion of 100 being important out. What is important is just seeing when we do get a move, digging in on that paper and seeing what people are doing. I'm very focused on time and sales as a trader. I always have been. When I used to work in the pit, I would stand there and watch the sales go across the tape, try to see what people are doing, feel the momentum of what people are buying and selling. And you can do this anytime looking into options on any stock or ETP just by going under time and sales, and you can watch it trade. With Thinkorswim, you can watch stuff trade in real time. If I were to pull up Lulu, I can go over to the very right and press the TS button, and it's going to show on the right side the sales. Now, I've talked to Thinkorswim before about this because obviously not every trade is on here. I was kind of wondering if they were manipulating this feed somehow to like only show more of the buys or more of the sales. But I've been assured by TD Ameritrade that they purchased this data from an outside data vendor, and it just picks up a sampling of the trades that are coming through. If you have a very illiquid issue, it might be showing pretty much every trade, but if you've got something that's trading constantly like Apple or something, there's no way you're going to get every trade because it would take so much bandwidth that it just wouldn't be economical to show it. But I look at time and sales. Not only this is obviously stock prices, but I also look in options at time and sales all the time. Especially when I have a certain spread on or options on, I'm going to look at in that month, whatever month I have a trade on in, I'm going to isolate, and I can go in Thinkorswim too. If I go to time and sales, I can go click on this little thing that looks like an umbrella or something, and I can set the fields, what fields I want to isolate in time and sales. So if I go to time and sales and click on this, I can select the month, I can select either calls or puts, and then I can select the which strikes even, or even by exchange. So this is important stuff. One of the things that was really interesting about the interview with Mark Sebastian a couple weeks ago was we were talking about spreads. Now, when you put a spread into when you try to trade a spread and you put an order for a spread into a system, that spread is going to get routed to terminals that market makers have, right? So which exchange you send it to could be important, and if there's really liquid options, it might even benefit you to trade sides of a spread independently of one another, because a lot of times, depending on who pays who, a spread is going to get routed to a certain spot, and it can be stuck in a certain spot for a period of time, and you may not get the best prices when you're trading spreads unless you're careful to route it to the right spot. And what I would recommend is try routing spreads to different spots and see which ones work better. Just to give an example of that, if I were to pull up Apple here, the market's not quite open yet, but if I were to pull up Apple and I were to key in a vertical spread here, so for example, let's say I was going to buy the 125 call. Now I'm going to press Control and do the second side. Okay, so this is buying a call spread. If you see on the right here, there's this field that says exchange, and you could select a specific exchange. And I would try these with different ones out. You know, I sort of favor the SIBO because I used to work there, but I would try these out. ICE might work better than SIBO in certain circumstances. If you do look on time and sales, you can see which exchange stuff traded at, and if one exchange seems to have the majority of the paper flow, for example, I found that a lot of my orders in VXX get filled by the Fillex, right? So you might want to route stuff directly to the Fillex to see if you get a better fill. Now, these little nuts and bolts of trading are where the money is made or lost. These small things, and that's kind of true in life with many things. You know, the small details are what make or break you. So I would really focus in on any products you're trading and get to know not only, you know, if you're trading, like for example, I'm trading in VXX, I'm long these set puts right now, right? So I'm watching time and sales in September options constantly. Not that I can, you know, control what's going on, but I want to know what's going on. If somebody comes in and buys 500 of these options, I want to know about it. For example, yesterday we had a couple small buyers of this. We had a sell. Now these are pretty illiquid options, but we had, you know, a couple 1-lot buyers. We had a 5-lot seller. In June we had put buyers. I want to know the pulse of what's going on in my product. Remember, when we're trading, we're competing against some of the best minds in the world, and we want to be on top of it, because if we're not on top of it, we're not going to make it. So if you've got a spread on in, I don't know, Apple, I would be following that month and figuring out what the paper's doing. At a bare minimum, I would be looking on the right side here at these average implied volatilities and seeing how that stuff is moving. Just because I'm not a huge chart guy doesn't mean that I'm not going to try to be the foremost expert in whatever small part of the financial world I'm involved in at the time. Because, you know, like I said, we're competing against really smart people. You're going to have to be on your toes. The only way to make money in the market is to take it from somebody else, and that's not an easy task. So don't be real lax and just sit back and think that money's going to come to you, because it really doesn't work that way. All right, so we had the kind of the next move down in a lot of these products yesterday. If we look at a chart of VXX, we were hanging out at this certain level for a while, and we've kind of moved down that next little notch. We were unable to break, I think it was like 1680 for a few sessions, and we've finally gotten below there. Look, if you look at this chart here, we had like a week where we're just bouncing in this range between 17 and 1750, and we were able to kind of break down below that yesterday and go down that next little notch. Now that certainly, you would have noticed that in your P&L if you're short this stuff, and we'll see if we continue to move lower actually in the VIX. Overnight stuff has kind of moved around. It's very annoying. I don't know if you guys noticed this before, but every once in a while on Thinkorswim, they kind of resort your watch list, and I have this stuff in the way I like it, and they switch it. It's like they update something and it switches my watch list around. Now it's got all my futures on the bottom instead of where they used to be on top. So I've got to go manually drag them around, and I'm gonna spare you watching me fail at dragging stuff around. But it's very annoying how like they put these updates in and it moves your watch list around. So yeah, we're seeing VXX moving lower. We closed 1659. Now we're down to 1641. Just to refresh you about my positions right now, I'm long VXX September puts. The Greeks for me right now show me short. That's not right. That one shows me long 600 deltas. But in reality, I'm short 900 deltas here. So, you know, down 900 deltas means down, down 10 cents. I theoretically make 90 bucks. Now, this isn't going to be super accurate because the option that I'm long is trading $1 and around $1.30. So, it moving up, each penny it moves up is going to be $64. But so this number is it's a rough estimate. What's really going to happen to the P&L is it's not going to move, and it's going to move in big spurts, that sort of thing. Only by trading for a while will you start to feel the actual how P&Ls kind of move. This is a rough estimate, this number. Now, the closer to at the money the options you're trading at, if my short came from options that were at the money, close to the actual price of the underlying right now. It's 16 and change. If my short came from the 16 strike, then this number would be a lot more accurate. But because my Greeks come from a way out of the money option, the 10 puts, this number is not going to be accurate because the price of the 10 puts is going to bounce around due to supply and demand, due to the skew changing, due to volatility changing. If you look at the Greeks above my head here, this option has the Vega associated with this position is 210. That means for a 1 point move in volatility, if volatility goes up 1 point, my P&L is going to go up by $200. If volatility goes down 1 point, it's going to go down by $200. And just as we move around and the skew, sometimes the skew is going to be steeper, sometimes it's going to be flatter, and just as the skew moves back and forth around, that's going to affect the pricing of this option. So this delta, because it's a way out of the money option, this delta is just a rough approximation, and that's always going to be the case when you're trading like way out of the money option. So I would bear that in mind with a position. This is not, if this moves down $1, I am not going to make $900. I might make 2,000, or I might make 500. It's really going to vary a lot from this particular number. But the good news is I already know that's the case, and so it's not going to be a surprise to me. All right, well, I've been gabbing for a little while. I'm going to check my chat real quick, and then I will let you get on. Do you ever just go short VXX or always options? I never go short just VXX, and the reason for that is that if we spike upward, there's an unlimited level that VXX could go to. Now, in reality, it's not going to go up that much, but if you put a short on, you can actually, you could lose everything in your account plus more, because the higher VXX goes, the more cash they're going to require for me to hold that position. So, for example, right now, the Greeks on my position says short 900. However, if you look higher up, it's only 700 up at 18. Now, let's compare if I was actually short 900 shares to the position I have now, right? So let's quickly do that. All right, so if you look, I've expanded here the Greeks. Now, if let's say that we were to spike 50%, up 50% from here, I'm no longer short 900 deltas. I'm only short 300 deltas, and it shows me up 50%, I'm going to lose $4,800. Yeah. So let's compare that to being short the stock. So let's go in and sell some stock here theoretically. So I'm pulling up a stock ticket, then I'm pulling it into the Analyze tab, and then I'm going to adjust the level. So let's say that I sell 900 shares of stock, and then we'll get rid of the rest of the position. Okay, so if I'm short 900 shares of stock, up 50%, instead of losing 5,000, I'm losing 7,600, A, and B, it's going to require me having $38,000 in capital to keep this position on, right? This account has $8,000 in it right now, and I'm able to capture the move to the downside, being short 900 deltas, with only $8,000 in capital, and I don't have that risk. To up 52%, I'm losing, not twice as much, but a lot more, and I'd have to deposit $38,000 to sell 900 shares at this particular spot. I'd have to have 25,000 in my account, and that would go up by $13,000, up 52%. Now let's go to the extreme here, up 100%. Up 100% here, I would lose $14,700. And I'd have to have 50 grand to finance that. Now, if we go back to the position I have on, up 100%, I would lose $6,000. So my account would still be intact. I'm not out of business. Whereas if I'd sold the 900 shares, not only would I be out of business, but I would have lost. Let's see, what was it? So I would have lost 14,000. So I would owe Thinkorswim, $6,000, $6,000 or $7,000, and I'd be out of business if I actually sold the shares and it was up. Now the plus side with the shares is that there's no decay. If we look at the options, this position is costing me $30 a day in decay. A, B, it's going to run out of time, right, in September. I got to have something happen before September, or I'm not going to make money. So there are advantages to being short the stuff, but I'd rather sleep at night. And no, I never use the stocks to short the stuff. Now, when you have a leverage situation, it's even more extreme. Remember, TVIX went from 38 to 1,000, right? Now that's several 100%, and so if you'd sold 100 shares, you would have lost thousands and thousands and thousands of dollars. So I prefer not to play that. I'll rather use the options where I know how much I can lose. I know that the most I can lose is what I pay for a put or a put spread. And with this trade, I plan on hedging it and getting rid of this data at some point. But the point, I guess the most important point I'd like to make to you is you can go into your computer and you can model these things. You can check out all this stuff and see, well, what if I sold the shares? What would my risk be? What if it went down 100%? What if it went up 100%? And you can make that calculation for yourself, and I would encourage you to do it ahead of time before you're going to put a position on. Check out all this stuff. Well, what if I bought Sep puts? What if I bought June puts? What if I sold December call spreads? And model it, play it out in your mind. The worst case, best case, play it out in your mind, and analyze this stuff for yourself on any trade you're doing. It doesn't have to be in the VIX. And be educated, know what you're getting into, and know what the risks are, and then you can go into it with open eyes, and if you lose, at least you understood what risk you had on. Yeah, VXX could go above 100, sure. Well, the price of VXX is related to the futures, but it doesn't and the futures could go over 100 also. 100 is no magic number. However, and VXX is not leveraged, so it's not as crazy, but certainly we could go higher. I was talking about TVIX. TVIX is a product that doesn't exist anymore, but it was a 2 times leverage product. It's now called TVIXXF, so if you pull up TIVXF, UVXY is a 1.5 times leverage product. That means if the futures go up 5, then this product should go up. If the futures go up 10%, this should go up 15%. With TVIX, if the futures go up 10%, TVIX should go up 20%. And it doesn't exist anymore. They got rid of it. But during that February spike, TVIX went up. If we look at a chart here, it went up to 1,000 from, I think it was like 38. It says, what does it say here? It says 45 here. We'll call it 50 just to be safe. It went from 50 to 1,000, right? So certainly you don't want to get caught in this situation, and a lot of people did get caught in this situation. And there is a product that is going to replace TVIX coming up soon, that they're going through regulatory hurdles right now to replace TVIX, and there certainly could be a leverage product in the future that is like this. So we want to protect ourselves against big moves like this in these products ahead of time. You know, the other big day we had was Volmageddon a couple years ago, which was this spike back here. And that was in one day. We had this huge move. where stuff went crazy. And on top of that, we had a situation after the close where there was no liquidity in the futures, and the futures just exploded. So yes, the stuff can happen. I would think of it more in terms of percentages than in like absolutes, like the number of 100. Right now, it would be very, very, very hard for VXX to go to 100 because it's down around 16, and 100% move up would be 32. So for it to get back to 100 would be nearly impossible. However, this will split soon, and as soon as it splits, this will reverse split soon, right? So if it gets to 5, they'll bring it back up to maybe 25, or if it gets to 10, they might bring it up to 50, right? And then all of a sudden, the likelihood of it going to 100 is much more likely. So I want you to be ready for this stuff. Also, Uvxy is going to split soon, and that could be back up around the 50s or 60s, and the likelihood of it going to 100 is going to be more likely soon. So don't get caught up on the specific numbers. Be aware that your position could move 100% against you, because I don't want you guys to get caught by surprise. Yes, SVXY is 0.5 times. I don't talk about SVXY as much. A lot of people kind of think it's wimpy because it's only 0.5 times. There is some options trade in SVXY. It used to be, before they quote-unquote nerfed all these things, Uvxy was 2 times leveraged, and I believe SVXY was 1 times leveraged. I can't quite remember, but it is a valid. If you look at the chart though of SVXY, you can see it came down. A lot of people were just buying SVXY, and then it slowly moves up over time. And indeed, you can see, besides that huge down move from 500 down, it moves slowly up over time. You just don't want to be there when it makes that huge crash. Now, it wasn't a 500-point crash. This is reverse split since then, but it still was a big deal. These products can be great to ride. It seems like it's a breeze to ride Uvxy or VXX down right now, right? When you see it, it's just going down every day. And so it seems like, oh, you just get short this and make money every day. And that can happen for periods of months at a time. These products go straight down, but then you get in a period where they just go all over the place. So it's something that it can seem like easy money for months and months. You can be making money all the time in these things, and then all of a sudden you get that one big pop and you give up everything that you've made. So that's why I try to educate people on how this stuff works. Isn't VXX matched? I'm not sure what that means. All right, anyways, I'm going to let you go. All right, so VXX futures over, VIX futures over 100. Well, let's just look at the VIX for a second. Like I said, 100 is just a number. It's just a number, and if the market crashes, volatility will go very high. Let's look at. Let's see how far back we can go in the VIX. The period of the COVID, we got up to 85 in the VIX. But the deal is that if we go into a period, the VIX will go very high if the market crashes, for one thing. But if we go into a period where the futures are in backwardation, where the front month future is way higher than the second month, then that will tend to pull these products higher and higher. Let me see if I can go back farther. I'm not sure if the VIX has been over 100 before, to be honest with you. However, it possibly could. And the issue you get into is when you have a leveraged product like Uvxy. As days go by, if you keep getting up moves as days go by, that 1.5 times leverage starts to compound your problem. Let's see. Time frame. Let's see how far this will go back. 20 years. Let's go back 20 years. So yeah, it's showing the high of 85. So yeah, I guess probably it's very unlikely the VIX futures would go over 100. However, that doesn't mean that over time in backwardation these products can't pop by a large amount. And if we look at the history of UVXY, well, it shows it going from 900,000. That's because it's a reverse split so many times. So it's hard to look at it without splits. But you can see most recently UVXY went to 140 was the high, but TVIX went to 1,000, right? And nobody thought that this thing could go from 50 to 1,000. But what happens is these products have to buy futures to hedge themselves after the close every day, and if there's some sort of illiquidity in the futures prices can move to wherever supply and demand takes them. And if you've got several days in a row where there's illiquidity, this stuff can happen. Now, some of these products will, UVXY could potentially go to 0 in one day, and it could also spike really high. I'm intentionally trying to scare you a little bit because I've seen a lot of people lose all their money when we had a spike. So yeah, definitely be careful with this stuff. All right, I'm going to let you go. I'm talking way too long today, and I know you've got other stuff to do. So let me let you go, and we'll see you in the next one. Thanks so much for watching, and best of luck. It's a beautiful period if you're short this stuff because the stuff seems to be going down every day now. Looks like VIX could go through 20 very soon. Let me see. Thanks, everybody. Are there any charts that take splits into account? I don't know. You can look up when the reverse splits were and do it that way. Mimotronics. Thanks, Wyatt. Thanks, Tom. Thanks, Brent. Thanks, Mimotronics. Thanks, everyone, for watching. We'll see you next time.
You're watching Famous.